many times before, what is the difference between depreciation and impairment? And when I say depreciation, you can also think of amortization, because depreciation and amortization is the expected reduction in the value of a tangible asset if it's depreciation, and in the case of intangible asset it will be amortization. But impairment is unexpected reduction, and we took various examples. For example, if we're talking about the depreciation of a car, that your company bought a car as an asset and it is using that car, so there is wear and tear happening, the car is losing its useful life, but this is expected. As you use that car, it is expected to reduce in its value. But if the car has an accident, that will be unexpected, and that will lead to impairment of the asset. So with respect to your intangible assets as well, if they are reducing in value, which is expected, such as a patent has a limited life, and let's say that's 10 years, so with every passing year the patent will be worth less. But if there is some unexpected scenario in which that patent is just not worth what it was before, maybe because there's a change in technology or there's some new research that has come out which makes that patent useless, then you will have to reduce that value, reduce the value of that asset, and it will be impaired. And an extreme situation could be derecognition, where maybe it's completely worthless and you have to write it off, right? Or we can have other scenarios in which you can have derecognition, in which maybe you're selling that asset off, right? Or you're exchanging it for something else. So we're going to look at all of this in terms of the different impairment scenarios and how IFRS and GAAP differ with that, and then we will be looking at the derecognition of such assets as well. Right, so let's get started with the impairment, and as discussed, this is the unexpected decline. Compared to depreciation and amortization, which is expected, it just takes the useful life and allocates that cost across its useful life of the long-term asset. Now, IFRS and US GAAP take a different approach to impairment. Now, this is important, and I'm going to emphasize on this word recoverable amount. So let's say you buy a patent, right? Now, you bought it for $100 million. What is it worth today? Now, IFRS requires you to compare it with the recoverable amount. Now, the recoverable amount could be two things. One is its fair value, right, which is what you can sell it to somebody else for, or it is the present value of the cash flows that you can generate from it, right? Present value of future cash flows. And keep in mind, when we say present value, it is the discounted amount of these future cash flows. Now, if let's say this patent is for a cancer research drug and Pfizer has bought it, right? Maybe they can sell it to somebody else for 80 million, which is less than the 100 million. So do they need to reduce the value of this asset on their books? Does it need to be impaired? No, if Pfizer itself can generate more than 120 million. And when I'm saying more than 120 million, I'm saying even after discounting the future cash flows, if it is worth more than 100 million, which is the original amount paid, there is no need for impairment. However, let's say if Pfizer, whatever expected future cash flows it is going to generate from this patent is less than 100 million, the present value of that is less than 100 million, let's say it's 90 million. In that case, we will have to impair this asset to the recoverable amount, whichever is greater, 80 or 90. In this case, of course, we will go for 90. Now, if let's say in future you find out that, oh, we can actually generate a lot more money, So let's say this goes back to 120. Now the present value of future cash flows has gone to 120. So can you record this asset for 120 on your books? The answer is no. The maximum you can go back to is the original 100. So first you will come back to 90, and then the maximum you can go is back to 100. You cannot go above that, right? It cannot exceed its historical cost. So in IFRS, impairment reversal is allowed. This is very important, but to the extent of the original cost, not more than that. US GAAP is a different story altogether. First of all, reversal is not allowed, right? So if you impair the asset, you cannot reverse that impairment. First of all, you have to keep this in mind. But there is an exception here, and we will talk about that later, but I want to put it in your mind from now, because reversal is not allowed for assets for use, for internal use. So if you've got an asset for internal use, reversal is not allowed. However, if you classify that this asset is for sale, right? So you bought an asset and you classify that, okay, I'm not going to use it internally. You're just holding it for sale. In that scenario, if you have impaired it, right, you can reverse it as well. And again, here, the reversal can be only up to cost, right? That is allowed in GAAP, right? So this is an exception, but that only is in the case when you've classified that I'm not going to be using this asset, I'm going to be selling it to somebody else. So in that case, you can actually reverse it up to the cost. Anyways, the point is, how do you test for impairment in US GAAP? In IFRS, we saw that it could either be the fair value, right, or it could be the present value of future cash flows. But in US GAAP, it is the undiscounted future cash flows, not the present value. So naturally, US GAAP is being a little bit lenient on this, because instead of asking you to check the current carrying value versus the present value of future cash flows, they're asking you to check with the undiscounted future cash flows. So that, of course, is going to be greater than the present value, because the present value will be discounted. And let's take a practical example over here. So let's say, again, we're talking about that patent which has been bought for 100 million, and the fair value, let's say, is 80. The present value is 90, but the undiscounted value of the future cash flows, let's say, is 120. Why is 120 greater than 90? Because obviously it's not discounted. Now, in the case of IFRS, we would have had to impair this asset because 90 is less than 100. So we would have to impair to 90 in the case of IFRS. But in the case of US GAAP, we will not have to impair because the undiscounted value of the future cash flows is still more. So we will continue to record at 100, right? Now, if there is an impairment, what is the impact on financial statements? Of course, the value of the asset goes down, right? Ratios such as activity ratios, where you're seeing what is the sales to the average value of your assets, will be impacted because your asset value will go down. So your overall activity ratio will go up. Because of that expense, your income will be lower. And this is in that period. In subsequent periods, it will be different, because what will happen is once the asset value is lower, the depreciation expense will be lower, and therefore your income will be higher. But in the period that the impairment is done, the income will be lower because you're booking that expense in that period. And because your income is lower, obviously your profitability ratios will be lower as well. Now, cash flows are not impacted as far as the asset is concerned, because you're not selling the asset, right? You're just reducing the value, the book value of that asset. However, because of the loss that you're going to record, or the expense that you're going to record, your profit will be less, and therefore you will save some tax. So that cash of the tax amount that's saved will definitely be there, but otherwise cash flows are not impacted, right? What about subsequent periods? Because of the lower asset value, the depreciation expense will be lower and therefore income will be higher, and because income is higher, profitability ratios will be higher, and that average asset value still remains low, so therefore your activity ratios remain high, right? And this is a very good example, and let me walk you through it so that you are able to really understand the difference between IFRS and US GAAP with respect to checking for impairment. So let's say there is an asset which is on the books for 8,000, right? Now under IFRS, what are we going to compare it to? I told you there are two things. First of all, we will check it with the fair value, and second of all, present value of future cash flows, right? So it's on the books for 8,000. The fair value, if it's sold, is 7,000, but there is a cost to sell, so that has to be subtracted, and we can either recover, and think of this like the lower of cost or market in the case of US GAAP, and the lower of cost or net recoverable value, NRV, right? So this is similar to that, but that we studied in your inventory. Here of course we're not talking about inventory, but the concept is the same, that what is your recoverable value, the net recoverable value, and that's 6,000. We're going to compare that to your present value of future cash flows, which this is 6,800 and this is 6,000, right? And 6,800 is greater, so we'll just go with that. But unfortunately 6,800 is lesser than 8,000, so under IFRS there will be an impairment. And how much will that impairment be? It will be 8,000 minus 6,800, which is 1,200. Now what about US GAAP? In US GAAP, we will compare that 8,000 carrying value to the undiscounted future cash flows, right, which is 9,000. And since 9,000 is more than 8,000, no impairment will be recorded under US GAAP. So hopefully this concept is very clear for you now. Right. What about other impairment scenarios? So we're not talking about assets with finite lives. Now we are talking about indefinite or infinite lives, right? Such as goodwill. Now these cannot be amortized because amortization obviously is based on a certain useful life assumption. And if an asset is having an indefinite or infinite life, then naturally you cannot amortize it. What you would do is test it for impairment, right? And we've discussed this many times before with the Facebook and WhatsApp example and the goodwill, that you need to check whether it is still having the value that you thought it does. Now, another very important scenario is if you classify that asset to be held for sale. Now, this has a major impact on the US GAAP because US GAAP allows reversal of impairment in this scenario. Of course, that is also up to the cost, not more. But this is something special for US GAAP because, as you know, US GAAP otherwise does not allow reversal of impairment, whether it is for inventory or it is for long-term assets. US GAAP does not allow reversal of impairment, neither for long-term assets nor for inventory. The only exceptions are, number one, if the long-term asset is held for sale, then US GAAP does allow reversal of impairment, of course, only to the extent of your cost, right? Not more than that. And the other exception that you might remember from our discussion on inventory is that for commodities, US GAAP also allows reversal of impairment. And not only that, it even allows it to be more than cost, right? So even IFRS is of course very lenient on commodity prices. And the reason for that, of course, is that commodity prices are very volatile. So both IFRS and US GAAP actually allow for the commodity values to be recorded higher than their original cost. Anyways, coming back to your long-term assets, US GAAP does make an exception for those long-term assets which are held for sale, and you can reverse their impairment to the extent of its original cost, right? But you can't just reclassify every asset as held for sale. There is some criteria for that. Number one, you should have a solid intention to sell it, and it should be highly probable that you're going to sell it, right? Then it can be reclassified as held for sale. No need to depreciate or amortize these assets anymore because they're not being used, right? Because they are not being used anymore. So therefore, why would you depreciate or amortize them? Now you have a very high probability that they will be sold. So just check what is the value that at which they are highly probable to be sold, right? So you test for impairment. If the value that at which they are expected to be sold, like their fair value or the present value that you're going to get from them, is less than what you're holding it on your books, then you need to impair it. You can reverse that impairment under IFRS and US GAAP if the value of the asset recovers. So that is, of course, exception for US GAAP. But as always, for IFRS and for US GAAP as well, in this scenario, the reversal is limited to the original amount, right? You cannot go above the cost. Right, now we're done with impairment and we're going a level ahead towards derecognition, that you completely remove that asset from your books if it is expected to provide no future benefits. Now, when does that happen? Either you are selling the asset, in which case you might record a gain or loss depending on how much you're selling it for and what was the carrying value of the asset on your books. Maybe you're abandoning the asset, so definitely whatever is the carrying value will be recognized as a loss, because that is something which is just going to disappear from your books, right? So that loss has to be recognized. Maybe you are exchanging the asset, so again here a gain or a loss can be reported depending on what you're exchanging that asset for. What is the fair value of the new asset that you're getting? Is it more or less than the carrying value of the old asset? Or it could be distributed to the owners in a spin-off. Here, of course, there is no gain or loss. It's just entire cash generating unit of a company is spun off. Now, this is something that is complicated, because in this scenario, you're just going to carve out a piece of your business and just make it separate, right? So it just becomes like owner used to have one company before, now the same owner actually has two different companies. So there's no gain or loss, it's just that you split a company into two. Right, now moving on to the presentation and disclosure requirements. First, we will talk about IFRS, which is actually more in terms of the requirement of your disclosure compared to US GAAP. Because here they're asking for your measurement basis, the depreciation method, the useful life details, the gross carrying amount and the net carrying amount, which is after adjusting for the accumulated depreciation, and then finally coming to your net carrying amount. Of course, the US GAAP is also asking for majority of these things. So they will ask your method of depreciation and whatever has been the depreciation recorded, right? But they are not going into so much detail. Let me explain this to you with a very practical example. So see, IFRS goes into the different nitty-gritties of things. And even though it's not a practical example that I'm about to give you, because it's not an intangible asset, but let's talk about a tangible asset such as aeroplanes. IFRS requires you to show the depreciation of each of the components separately, right? Like the wings, the engines, the cockpit, the seats, everything separately. But your US GAAP just asks at a high level. So for the entire plane, you can just have one carrying value, which means one depreciation for the entire plane. So this is what is the major difference between IFRS and US GAAP, right? It's less exhaustive. US GAAP is less exhaustive. Now, in terms of impairment losses, that was for depreciation, amortization. This is for impairment. Now, impairment losses, well, the major difference over here is that reversals are allowed under IFRS. US GAAP does not allow reversals, right? I know you must be thinking that it does allow for assets that you are planning to sell, but here we're talking about assets that are held for use. So reversal of impairment is not allowed for assets that are held for use, and that is majority of the assets that you have, right? Your long-term assets that you're keeping, you're not keeping them because you're planning on selling them. Majority of the companies, they have long-term property, plant and equipment because, or long-term intangible assets because they are actually planning on using them. And since reversal of impairment is not allowed under US GAAP, therefore no need to provide any details of that. However, whatever impairment you are doing, you need to provide the details of that, how you are doing it, you're calculating the fair value, what is the detail of that, and if you have recognized any losses, what details are there for that. So US GAAP asks for all that, and so does IFRS, that if you have got any impairments or any reversals, you need to provide why it was done, how it was done, and what was the basis of your fair value, and how did you recognize this impairment or any reversals that were done. Now, how does all of this come together for us as analysts? Well, what we are most concerned about is that if we are investing in a company, we want to see its long-term assets. What is the quality of its long-term assets, right? Are they very old? Does the company have to spend a lot of money in maintaining these assets? What is the remaining useful life? What is the age, right? How old are they? What is the remaining useful life of these assets? And how much sales are these assets generating for us? So let's start with the first one, which is fixed asset turnover, where we take the revenue and divide it by the average value of the fixed assets, which is opening balance plus closing balance divided by 2. So this gives us an idea that what is the dollar amount being generated by these assets. Number one. Number two, we want to find out how old are they, right? So how much of a depreciation has been booked. So let's say if an asset was bought for 100 million and the carrying value is only 20 million, which means 80 million has been depreciated, right? And if we know that the annual expense is 10 million, so 8 years of this asset's life are already done. So by taking the accumulated depreciation and dividing it by the average annual depreciation expense, we can get an idea about what is the age of this asset. Secondly, if we take its carrying value, which is 20, right, in this scenario, and we divide it by the annual depreciation expense, we find out that there's only 2 years left for this asset, right? 8 years is done, 2 years is left. So that's obviously not a good thing, because older assets will definitely need more reinvestment from the company to keep going, to keep generating this sales that they're generating for you. And there is some other interesting things that we can analyze from your financials. So first of all, we can calculate the historical cost. Well, it's going to be given to us anyways, but in case it is not there, you can take the accumulated depreciation and the carrying value, right? So the carrying value and the accumulated depreciation put together obviously has to be the historical cost. And in our example, it was 100 and 80 and 20, right? So that is your straightforward formula, that the original historical cost is whatever is the carrying value plus the accumulated depreciation, and that historical cost divided by the annual depreciation. So the 100 divided by 10 is going to give you that 10 years was this asset's estimated total useful life. And let's say if 8 years has passed and 2 years is remaining, so this will give you that the total useful life is equal to the age of the asset plus the remaining life estimated. So this is the big picture for the assets, the long-lived assets, and we can get an idea about what is the status of these long-lived assets within a corporation before we decide to invest in it. Right. So that is the end of this learning module. Let's have a look at the summary. We talked about purchased intangible assets. You can record it at cost. If it's finite, you can even amortize it. If it is infinite, you have to test it for impairment. If you're doing it internally, if you're developing them internally, research costs are expensed, right? Development cost can be capitalized in IFRS. In US GAAP, even the development costs are expensed unless you are working with software. And US GAAP is lenient in this scenario. If it is for internal use, you don't even need a technical feasibility for that. However, if it is for external use, you need to establish a technical feasibility. And for IFRS, you need to establish a technical feasibility for all situations before you can capitalize your development expenses, right? All right. What about, intangible assets acquired in business combination? Well, whichever are the separately identifiable ones, such as patents, copyright, trademarks. I give you the example of Lay's, right? So they will be recorded at fair value. And if any corporation is paying a price above fair value for a company, that of course is goodwill. And then how do you impair them? For IFRS, we have to look at whichever is greater of either the fair value less the selling cost, and here we looked at an example of 7,000 minus 200, which was 6,800, or the present value, which was 6,000. So obviously 6,800 was greater, and our carrying value was 8,000. And we said, okay, 8,000 is obviously more than 6,800, and we recorded an impairment of 1,200. In the case of US GAAP, of course, we compare the carrying value to the undiscounted value of the future cash flows, which was greater in our example, so we did not have to record an impairment. By the way, of course, as you know, if there was an impairment recorded, reversal is not allowed in US GAAP. In IFRS, reversal is allowed, but only to the extent of the historical cost. Right. And if impairment is done, what happens to your financial statements? Assets go down, so activity ratio will go up because assets are going down. In the period that it is done, your income will take a hit because of the impairment expense. Your profitability ratios will be lower. Cash flows per se will not be impacted, but of course you will pay lower tax because of the lower income. In subsequent periods, however, your income will be higher because of lesser asset value leading to lesser depreciation expense, and therefore because of the higher income, your profitability ratios will be higher, and because of the lower asset value, similar to the case over here, your activity ratios will continue to be higher. Right. In the case of derecognition, either you're selling the asset, in which case you will have a gain or a loss depending on what you're selling it for, more or less than the carrying value. Similarly, if you're exchanging the asset, again, you can have a gain or loss because what is the fair value of the new asset versus the carrying value of the old asset. If you're abandoning it, of course, there's only going to be a loss equal to the the carrying value of the asset, because that will be removed from the balance sheet and you have to recognize that much loss on your income statement. And if it is distributed in a spin-off, no gain or loss will be recorded. It's just going to create a separate company. Your derecognition could result in a gain or loss depending on what you're selling it for or exchanging it for compared to what is it on your books for, right? So that could lead to a higher or lower net income and a higher or lower assets, right? If it's a loss, it will reduce your assets and reduce your net income. If it is a gain, your income will increase and so will your assets. Right. And finally, how do we as analysts take all of this into account when analyzing tangible and intangible long-term assets? We want to know the age, right, which is how much depreciation has already been done divided by the annual depreciation. So this will tell you how many years this asset is already been used up, right? What is the remaining amount right, is basically what is the carrying value divided by the annual depreciation expense. So this is the remaining useful life. And if you add those two, that is the used up age and the remaining useful life, you will get your total useful life, which is that original cost divided by the annual depreciation expense.